Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Steve, welcome back to the Australian Investors Podcast.
Thanks, Owen. It's great to be back, and it's been a while.
It has been a little while between drinks, but caught up with you in Sydney recently. It was just so good to meet. I think the first time we ever did a podcast together, I think it was the third episode of all time. So that would have been, way back in 2017. And so there's been a lot of volatility, a lot of ups, a lot of downs. But it's good to see Forager still going strong, mate. And you still, doing your thing. I think when we did that episode, in the beginning, I gave the titles of our shows, it's like one word that describes the interview. And I think from memory, for yours, it was genuine, because just speaking with you came across so genuine, and everyone in the community and everyone that told me about you was like, yeah, he's just a really honest, good guy. And so it's good to see Forager still going from strength to strength, mate. Indeed.
Maybe back going strength to strength is a better way of putting it on, because when I had that last podcast to you, everything went downhill very quickly in the subsequent 2 years after that. So let's make sure that this one's not another harbinger of problems to come.
I'm certain it won't be, mate, because we don't have that type of influence here on the Australian Investors Podcast, but touch wood in any case, mate. So today we're going to talk about two companies. We're going to talk about Catapult, ASX CAT, and EML Payments, ASX EML. Now, Catapult's been brought up a few times on the show, so we're going to run through that. We're going to talk about the business. This is not about stock tips. It's not about, buy, hold, sell. That kind of stuff's really myopic, in my opinion. It doesn't serve investors well. And it also doesn't demonstrate the amount of work that you put in to understanding these businesses and their prospects. So we're going to talk about the businesses and we're going to pull them apart. EML is an interesting one because we interviewed the former CEO on the show, and then maybe, like you said, Harbinger, who knows, it ran into a few issues, which again had nothing to do with the Australian Investors Podcast. So we shall see, mate. We shall see. But if you're listening to this or you're watching this and you like the show and you want Steve to come back, I definitely do. Just let us know. Jump onto YouTube in the comments or send us a message the same way you would ask a question, like in the community or via email. Because it's an absolute delight chatting with not just Steve, but the team at Forager. So, mate, I think you wanted to start with Catapult, if I'm not mistaken.
Yeah, I think that'd be a good idea. And look, if people happen to go back and listen to that 2017 podcast, I think both of the stocks we talk about today, you're going to see me talking a lot about the portfolio management aspect of what we do. And I think it's the area that we've made enormous strides forward in over the past few years. And as I've got older, I've got less and less confident about things, and there is just, you touched on it earlier, it's been a pretty wild time out there in the world, but it is an uncertain world, and for me, any investment, there are things that can happen to it that you haven't thought about or that are just completely outside the businesses or your control. So we're going to talk about two businesses today that are at different points, I think, in that uncertainty curve, and Catapult's the one that's further down that path than EML.
Yeah, because when I looked at it recently, the business, which I'll get you to tell everyone what it does in just a moment, but when I looked at it recently, just, the share price is only one indicator of a business and what it's doing. But I looked at it recently, I was like, wow, it really has snapped back in a very big way. So I know you've held it for quite some time. Maybe let's start with the business writ large. Like, what is it? Where does it come from?
It actually comes out of the Australian Institute of Sport, and the core of the technology here was built around the 2000 Olympics. So at the Institute of Sport, they were trying to do things to help us get more gold medals at the Sydney Olympics, and some of the GPS tracking technology that they have basically came out of that, and the business itself was founded in 2006 down in Melbourne. And put simply, it was GPS tracking devices on elite athletes. Their first customer was Hawthorn Football Club in the AFL. And you see this product, if you're watching any sport, you see this product all the time. It's underneath the jerseys of the Australian cricket team now. See any football code in Australia where they take their shirts off, they've got a vest on underneath it. And Catapult has a GPS tracker, now heart rate monitoring, now a whole heap of stress factors that go into that that vest that they're wearing around, and that has pretty much been the business from back then, and it's still the core of the business today. They are 5 times bigger than their next biggest competitor in that space. They now have 4,000 professional sporting teams around the world, and that product that was developed at the AIS is the core of what it is.
It's interesting because didn't it go through a bit of that prosumer phase where some local, blokes that run out in the footy oval like myself, I didn't get them, but there were blokes out there that had those little GPS Adidas trackers or Nike trackers that would go in your shoes. And then there was a moment where, if I'm not mistaken, Steve, Catapult also had like a big video analytics thing, which is still, I think, part of the suite today. But there was those, what I would quote, those other parts of the business too for a while there.
Yeah, and still there, the video piece. And I think back to the way that we got involved in this stock, and almost everything that we own is usually going through a period of uncertainty, or the share price is in the doldrums and people are upset with it. That's where we find our opportunities. And Catapult's had that journey itself since listing. It was a darling stock. 2016 it IPO'd and the share price was going nuts. And both the management team and the board, I think, were pretty excited about that. And the market at the time was obsessed with growth, and all you needed to do was grow, and it didn't matter how much cash you burnt to get there, your share price went up. And they did some things that were not optimal from a value creation perspective. They paid a lot of money for a video business that I think is going to be an important piece of its future, but massively overpaid for that. And probably more importantly, started thinking they could be everything to everyone, and that's where that prosumer piece of it came in. They were going to sell a retail subscription to the average person running around playing rugby on the weekend. It cost a lot of money. The go-to market was not the same as the existing business that they're in, and the share price might have hit $4 at one point, $3.80, $4, all the way down to 70 cents because those things weren't working, and because investors started to, well, I'd say the investors that were in that tech bubble probably went broke. And then the part of the market like us that is more focused on how much money is a business going to make started demanding that companies actually don't burn as much cash as they are. And to their credit, I think the Catapult team got that message and brought in a new management team here 3 years ago, which is when we started getting interested in it, and got rid of all of that peripheral stuff and said, look, our business here is professional sporting teams. Not only are there a lot of them already, but they're getting bigger. The number of sporting teams is growing. We're seeing women's sport. We're seeing different codes, different sports themselves actually become professional and need all this technology. So it focused back on that core market and said, we need to service the customers that we've got and that market much better than we have been, and to continue growing. And it had grown in that core professional market all the way through the dramas.
How does it make money, Steve? So you described that the GPS on the back, and they put that in their jersey or underneath on that like bra looking thing. How does it make money today?
It's subscriptions, almost all subscriptions. So the clubs will pay per player, and they'll pay. It works out at something like on average $20,000 per professional team. Obviously, bigger teams with more people will pay more than that. Smaller ones will pay less, but it's not that much more than $1,000 per year per player. And we had an expert call with a guy at Chelsea here one day who said, if this company can keep one of my players on the field for one extra day in a season, they pay for the whole budget for the technology. So we can maybe talk about this later, but this is a very, very much an expand phase of this company's life. I do think there will be pricing power here. I think they're right not to use that pricing power until they get as many customers as they possibly can. But it is hard to imagine in 20 years' time that $1,000 per player is the right sort of number for this technology, especially as the technology gets better and better.
Yeah, definitely. Did you say Chelsea is in like Chelsea soccer?
Yes.
Yeah. You've managed to mention my two teams in the first 10 minutes of this discussion, both Hawthorn and Chelsea, the two teams that I follow worldwide. So kudos. Maybe you knew something and you're just trying to butter me up, give you the easy questions. But I'm very happy with this. Maybe they're just the two teams that have some money. So maybe that's another thing.
Yeah, and the deals are different. So football is they're not as dominant in football as they are in, say, AFL or NRL, where they've got league-wide deals where the league mandates you must use this technology and will help supply it because they want the data across the whole league, and the TV broadcasting stations also want the data so they can show you how far and how fast this person's running the game. That's all coming from Catapult. So in the EPL, it's a bit more of a mixed space, and in the video part of their business, they've got a fairly large competitor called Huddle, and they are big in the EPL as well. So it varies by sport, but in that tracking space, they're very dominant globally.
I remember, Steve, and forgive me if I'm butchering this, but I think the new CEO, Will Lopez is how I pronounce it. I think he was talking about, when you drive, you watch the F1 and say they're going around Monaco, and then they'll say there's like a 54% chance that this person's going to overtake that person or something like this. They give you some sort of predictive analytics. I can't remember if he was talking about that coming to Catapult or if it was already in play. I cannot remember for the life of me, but that idea of like predictive analytics as well is super powerful.
They own that piece of technology, so it's quite a meaningful revenue stream for them, the Formula One. And more importantly, the technology that they're using there is proving very applicable to other spaces in terms of that predictive technology. And I think as the biggest player by some margin here, you have more data than anyone else has got. They've got, English football teams coming to them and saying, we've got this problem, and them going, well, we've got this team in the NFL that dealt with the problem this way. How about you think about it like that? And this video technology that's in the Formula One is really seems to be translating quite well across to some other related activities across their business. So that's a part of the business they're quite excited about. I don't think it's ever going to be anywhere near as big as the rest of it, just on the law of numbers, but really interesting piece of tech that they own as well.
Yeah, it's fascinating. So, because I remember being from Victoria, mate, that's AFL, nothing else. There's the Telstra Tracker, which is like the tool that they use to like track AFL players' movements over the field and these types of things. And I think a lot of consumers don't realize where that actually comes from. Or like in the case of the F1, it was like the Oracle, like as in like, that, as if that technology company had anything to do with it. But they just kind of like, they whack a sponsor over the top, and the kind of the league-wide deal makes a lot of sense for paying for players. When it comes to what you and the Forager team look at in a business like Catapult, like what are the key metrics you would look at, whether they're financial, operational, like what are the things that you're looking for?
Yeah, that's a great question. And look, I think this thesis for us has gone about as well as we could have hoped. And when I was sitting here 2.5 years ago, and this company was still burning a lot of cash, and the CEO you mentioned, Will Lopez, had come in and said, first thing we're going to do is spend more cash here. The business, they'd done a number of acquisitions. It was sitting on a number of different platforms. The go-to market wasn't consistent around the whole world. So he had come in and said, look, we need to spend some more money here, but once we've spent that money, what I'm going to show you is very high incremental margins for this business. So we need a bigger cost base, but once we've got that cost base in place, as we add revenue, you as investors are going to see a high percentage of that revenue drop through to profitability. And we think that by the time we reach scale, now you never clearly define that, but you can do the numbers yourself. That's probably a couple of $100 million of revenue versus $100 million of revenue today. By the time they get there, the company said we can be 30% overall margins from less than zero today. They're at the losing money point. So they had laid out the thesis. We looked at it and said, and I looked at it and said, I love this business. I run through the Sydney Football Stadium precinct every day, and the Sydney Swans are out there training, and the Sydney Roosters are out there training, and now their women's teams are both out there training, and they've all got the Catapult stuff around the outside. It had always been a business for me that I thought was a perennial underperformer in terms of the quality of the revenue and the technology that was there. So when he laid out this plan, I said, well, that's exactly what it should be. It should be a high incremental margin business. And we took a pretty small initial investment there, so about 2% of our portfolio. And your question was, what are you looking for? Well, we needed the revenue growth to continue. So for us, that's 20% per annum of revenue growth. And what we wanted to see was that incremental drop through. And we got one result and we said, that's good. We can probably tolerate a bit of a higher weighting here. We're getting some evidence. We got two results. We got a bit more confidence. We've actually, despite the share price going up as much as you mentioned, had kept adding to this investment along the way because he just kept delivering every 6 months. Here's your 20% revenue growth and there's your incremental drop through to profitability. And in fact, it's probably gone better than it should go in future. This last half, the last 6 months, they actually had 75% of the additional revenue they generated drop through as profitability. You don't need it to be that high, but you do need that number to be north of 50 for them to end up at 30, where we think they're going to continue to grow from, to be honest with you.
Interesting. So Will came into the business at that time you mentioned, and he's delivered. You said that 20% revenue. Is there anything else? Like when a new CEO comes in, I often have the thought, I don't know, maybe if this is just something for us to riff on briefly, Steve. It's like, if he's come in and said it needs to be like incrementally profitable at a certain point and blah, blah, blah. I sometimes I think to myself, yeah, but why didn't the last guy say that? You know what I'm saying? So like, how do you think about that?
Yeah. And look, putting it in a slide deck and announcing it as a strategy is the easy part. I have a big sign up on the wall for our team talking about the hierarchy of evidence, and management told me so is right down the bottom of that list. It's almost worthless. And that's why for us it was, well, should the business actually be like that to start with? Answer was yes. Can it actually get to where they think it can get to? Answer was yes. And then are they going to deliver on that? And I don't think this one was a particularly complicated one, but I think any business is difficult to change the culture like that. So you need to upset a few people and you need to get a few things wrong. And Will is an American and he has a very American style of management about him, which comes with some stock-based compensation that we'll talk about later. But he's got that, we are going to grow this business and we're going to make it big and we're going to get stuff done here style about him. And we just, without getting super excited on day one, we said, well, this is interesting and exciting. And as we gather more evidence that he's actually going to deliver this could be a very, very interesting investment.
Mm-hmm. So speaking of, one of the things we should talk about are some of the risks that are involved in this business, because it does have a history where, and there's still directors that are involved in the business from back then, right? And they are the overseers of the executive team. And so what are some of the risks that you're watching or you've identified?
Look, I think the big one is some form of technological obsolescence, that there's a way that comes along of doing what they do that is more or less intrusive, I guess, than having a little device attached to your back. I can't see, simply because of their size and their R&D budget and the amount of data that they get, it's not going to be an incremental, someone comes along and does the same thing but does a better job of it. It's going to be someone comes along and does something that is completely unthought of at the moment that disrupts it. So that is a low probability risk that has a very significant impact. And then I think the capital allocation side of things is probably the more likely and bigger one. And I put the stock-based compensation into that same bucket of capital allocation. How many shares you're going to give away to staff here to achieve it is an important piece of the puzzle for shareholders to answer over time. And if that's dramatically more than it needs to be, then it's going to have an impact on your investment as well. I think I don't want to defend the existing board because I think they did get carried away at the time of the IPO, but I do think they've learnt a lot from that experience and they've got a lot of skin in the game. You've got, I think it's still 35% of the shares here owned by the two founders of the company, Sean Holthouse and Igor van der Grint, and Adir Schiffman, who came in pre-IPO as an investor here and is still the executive chair of this company today. I actually caught up with Adir the other day. He's been very open about this. You can find him talking about it on LinkedIn and things, but I think he would be the first to admit he learnt a lot from that first 5 years of this company being listed. And I think to his credit, he has really taken that on board and said, okay, I understand what I need to do now to attract the right long-term investors and to grow the value of this company rather than just get the share price up in the short term.
Yeah, that's great. That's really good. And you do want alignment and you want humility like that in any business, right? So That's so important. So I guess there's probably stock compensation is like stock-based compensation is one thing. And then the technology obsolescence. How would you know, Steve, if that's going to happen? Is it just through deeper research, with industry?
I mean, you can try and keep up with all of these things. I would say you probably need to put it on the slate and say this could happen. It's a low probability. And if it happens, I need to manage my portfolio weighting here accordingly. The second the market gets a whiff of it, it's going to have a pretty big impact on the share price. And look, I think the video side of the business is a lot more competitive than the GPS tracking side. So I think it's more likely that there are issues on that side of the business, and that is a potential foothold for someone into the other side of things. They want to be the ecosystem for the industry. So, all right, we're doing GPS, we're doing video. Well, we're not tracking people in the gym at all. We're not tracking what they eat as part of their diet. They want to be that core system for all of these professional sporting teams and bring all of that stuff into it. To the extent that someone ends up dominating in video and can use that as a beachhead to say, well, how about you try our GPS tracking stuff as well? I think it could happen that way around. At the moment, their main competitor on that video side of things is not very popular with customers. And I think they said as part of this last result, they got 300 and something new video customers in the past 6 months. And almost all of those have either come from or are also customers of Huddles as well. So they're doing really well in that space. I mean, I try and keep up to speed with it, but it's not going to be something I think that happens really slowly and incrementally. It's going to be something that happens with a big bang.
Final question on Catapult before we move on to EML is you mentioned before that you were buying on the way up. We're recording this the first week of December, and we try to keep it tight around here, Steve. We try and get the episodes out, pretty quickly, particularly when we're talking about companies. But in terms of your positioning at the time of recording, are you guys like holding through this period?
Yes.
Yep.
Yes. So look, we actually wrote a blog on this recently because we wanted to be really clear with the customer base. We have a big weighting in the stock. It was probably 8%. It's gone up, 40% in the past couple of months. That would have become 12 if we hadn't touched it. I'd say that 10% portfolio weighting is what we are thinking about at the moment, and that's contingent on it remaining at a price that gives us adequate long-term returns as well. I think the really simple way to think about this stock is it's currently trading at 6 times revenue. There's a new one for a value investor to talk about as a revenue multiple. But the way I think about it, where are we going here? We're going to 30% margins. You need to take 5% off that for the stock-based compensation side of things. So we're going to 25% margins. So if you were 1 times revenue, you'd be trading at 4 times those pre-tax profits. If you're 6 times revenue, you're 6 times the 4 times, you're trading at 24 times, where I think this business can get to sort of 4 to 5 years out. And so I think that sort of multiple justifies a 6 times revenue multiple for the business at that point down the track. So between now and then, you're going to get however much that revenue grows by, is the way that I'm thinking about it. Now, if it gets to 9 and 10 times revenue, you've got to start sitting there and saying, well, it might be 6 times revenue in 5 years' time, not 10 times revenue. And I need to think about how that de-rating impacts my valuation. But I think at the moment, I'm pretty confident that this business has all the characteristics to be a 6 times revenue or a 30 times earnings sort of business, and that the revenue is going to grow a lot between now and then.
Yeah, if they keep hitting those operational goals and retention and all those subscription revenues just keep falling down, that's great. So, and when I say falling down the income statement, I should be very clear about that. Mate, so the other business that we're going to talk about is probably, so it's not as developed in terms of the thesis and what you and the team at Forager are looking at. But this is a business, if I'm not mistaken, was it Tom Cregan? Is that his name? Previous CEO? Could be mistaken. EML Payments is the business, ASX EML. Global business now. Can you start, maybe this is a little bit more probably complicated for people just to get their head around. They wouldn't want to go too far into the technical detail, I'm sure, but just what is the business now?
Yeah, so I'll summarize that really, really simply. It is a payments infrastructure provider for people who want to pay or transfer money to other people, but they want to have some control over how that money is spent. So think it's a gift card. You go to DJ's, they want to give you a card that's got money on it, but they want you to only spend that money at DJ's. Shopping centre cards are a big one for them. Governments are big clients for them as well. They're paying people welfare. They're dealing with immigrants in the UK. Okay, we need to give you some money here, but we want to have some visibility over how you're going to spend that money. So that's the simple way of thinking about this business. So it's evolved to be digital. Obviously, it used to be all cards, but it's a payments infrastructure company, and at its core, it's actually providing a very useful service there, and quite a simple business to get your head around. And I think in terms of everything that's gone wrong, it probably, if they had stuck to it being that simple, then the business would be in a much better place today than it is.
How do you think about the business's history? Because a lot of people that would be hearing you talk about EML, obviously you're a value investor, you're looking for value in the market, you're looking for companies that they're often, they've got a few hairs on them. That's why you can get them at good prices, right? But this one in particular, it's probably gone down in infamy on the Rask network, because I held it for some time, and I spoke to the previous CEO and these types of things, and yeah, I mean, it didn't work out too well for me. So how do you think about the history of the business?
Yeah, maybe even before we jump into that, you said earlier, further down the thesis path, we're talking about one stock that has gone very well for Forager here in Catapult, and we're talking about another that's at the very early stages of the investment. Things go wrong somewhat regularly, and this is at the early stage, and I think it is still at a stage of our investment thesis where it could go either way. And what we're really trying to do is keep that weighting fairly small in the early days, especially where we think there's a lot of uncertainty. We had a small weighting in SmartPay, for example, recently. Decided, we got the very first result we got, and we said, this is not, the economics of what they're trying to do in New Zealand here are not what we thought they were. Let's cut this investment and move on. And we lost a tiny little bit of money, and we moved on to the next idea. This investment, our first bit of data here, is very good, we're going to talk about, but it's still really early days, and I want people to understand that in terms of the idea here is it is a fairly risky investment proposition because of everything that's happened prior. And I was exactly like you. I maybe had less of a previous experience with it, but I had watched this company go and do all the crazy acquisitions. It was a darling growth stock. For me, that was in the this is going to go wrong bucket, and I'm feeling pretty confident about it. So when it all did go wrong, I wasn't completely surprised. And then when my colleague and co-portfolio manager of this Australian fund, Alex Chevrolet, came to me and said, I really think this EML's interesting, worth us having a look at it, my first reaction was, don't even bother. This is such a pile of rubbish that I'm not interested in. It's been doing all these acquisitions. And he said to me, well, that is what's happened, but just let me lay out for you where we are today. New board, new management team. They have completely restructured this business. They've got rid of all of the things that were going wrong. It has been very painful. I mean, they did, I think it was $350 or $400 million worth of acquisitions over the course of a year, and ended up selling those two businesses combined for about $50 million. So a lot of shareholder money down the drain, but his view was this is back to something pretty simple here. It's what I spoke to you about earlier. It's gift cards, reloadable cards. It's actually a growing sector, and this is quite a good business at its core that is a part of it. So he almost had to bullwhip me into getting interested in this stock, and I think that's one of the opportunities about it, is it's got such a reputation out there amongst the market and amongst my fellow institutional investors that you just don't want to touch it, that the change that's happened has not been as quickly incorporated into the share price as it should have been.
Yeah, because they were getting into all sorts of stuff in the European Union, and then there was Brexit, and then account to account, and then it just kept on getting more and more complex. And I feel like I needed a 1-300 Steve number then, because I mean, it was just so much to try and understand. Like as an individual investor, if they invest with you, right, they take it, in confidence that you and the team look at it, you understand it. But if you're an individual investor looking at it, it's a pretty steep learning curve to understand a business like that. Like technically, like what is it actually doing? Who's in the marketplace? Which geographies are they in? And so you mentioned there that the business that is like that core reloadable business. You mentioned that it's kind of transitioned away from physical cards. So can you give us an example of the type of customer that would use it?
They still have a lot of physical cards, to be clear, but they've got a really big market share, for example, in the fleet management sector here in Australia. So if you have a car that you lease from an SG Fleet or one of those big leasing companies, or you work for a corporate where they provide you with a car, you get a card. When you fill up with petrol, you use your card. When you buy something at the shop, you use your card. And that card enables the company or the leasing company to track where you're spending the money. You get all your tax deductions from the government. So that would be an example. The Centre Group is a big customer of theirs. So you go and buy a Westfield gift card. Some you can buy those digitally now. That doesn't have to be a physical card. Some of them are still physical cards. They make their money out of breakage. So people that don't ever go and spend the gift card, of which typically that's about 10% of the money that gets loaded onto them never gets spent. And they get to keep that float or money and put it in a bank. So it's actually an important thing to understand about this business is that interest income is an important component of their revenue. So if interest rates go back to zero, that's going to be a negative. If interest rates stay where they are, it's going to be a positive. I'd say the expectation is they get cut. So that's how they make their money out of providing that card. And then, like I said, in the UK, government is a big customer of theirs as well. So if you turn up in the UK as a refugee and they need to provide you with housing and food and things, they'll give you a card and you can spend that card at Tesco and buy your groceries, but you can't go and spend it at the pub buying schooners of beer. Should be allowed to do whatever they want. It's their money. But yeah, so that's it's a summary of the different places in which they're using that technology. There are still lots and lots of different smaller components. So this business's largest operations are in the UK and then Australia next. It's also got a business in the US. It's got a little business in Ireland that's quite important to it as well still. So there's still quite a bit of stuff going on, but it is at its core back to that payments infrastructure.
It reminds me of friends that would work for like tradies that would work for bigger groups and they'd have to drive around and they would have those kind of like the Shell cards or like the BP cards and they would only be able to fill up there. Be like, why are we only able to fill up at BP? But it wasn't a BP card. It was just some random like Visa or MasterCard.
That's probably EML providing that sort of them or someone like them providing that technology. And then they can go and do a deal with Shell and say, we'll put all of our fuel revenue here through you if you give us a better deal or some sort of kickback on it. So yeah, that makes a lot of sense. How do you make sense of when a business like this, which was under a pretty charismatic and high performing CEO until it all kind of come undone, how do you then come in, look at it objectively and be like, well, what I'm saying is, like you said, you had that picture before of like the CEO said so. It's like down the bottom of that list of like signals you are under indexing potentially rather than over indexing that. How do you make a call that the person that's in there now is the right person? Like it doesn't have to be with EML, but just in general. Yeah, I don't. I try and think about these things probabilistically, and I think it's actually really important in these situations to not try and research yourself into the answer, because often that uncertainty is just there. And if you do more and more and more research, all you're going to do is make yourself more confident about something that is just inherently uncertain. So I think in a situation like this, is the core business here something that can be resurrected? And increasingly importantly for us these days, is it something that other investors might like at some point down the track? Can it grow a bit? Can it earn decent margins? Can it generate cash flow? We want to really, if we're going to invest in a turnaround, be investing in something that if we're right and it does turn around, can be popular again. And this was a very popular stock, and I think it has the characteristics to make it popular again. We need to see that the management team has changed, and here you've had the whole board has changed, and you've got a new manager in. We will go and meet with them. We will assess what they have to say about the future of the business. We'll try and meet. We pay money to expert networks where you can be put in touch with someone who used to work with this person at a different company, or try and meet people that have had some experience with them in the past. And then we try and make sure that there's enough upside in the situation to say, well, if this is another management misstep here and they get it wrong, how much are we going to lose? And if we get it right, are we going to make enough to compensate for the fact that we're taking on that uncertainty? And, here, they only did this last week. I suggested this stock to you before the AGM last week, and sort of unfortunately, they came out with their AGM update and laid out a really clear strategy for this business, and the share price has jumped 40% over the past week or so. But he has laid out almost our thesis that we had before he laid this strategy out for the company getting to 13 cents per share in 2028 of earnings per share. The share price was 68 cents or something a few weeks ago, and they're targeting, he's saying, low double-digit revenue growth to get there. So it's pretty obvious that if this business gets to 2028 and it's growing at 10% per annum and it's making 13 cents per share, it's not going to be trading in the 60s. It's going to be trading at many multiples of that. So we're not certain about this, but gee, there's a lot of upside, and we think it is a business that has the characteristics that the right management team can turn around and fix.
Yeah, well, I just looked at the share price since you emailed me. It was like 66 cents. And
should be front running the podcast, Owen.
Yeah, well, it was, that's, wow, okay. We had a
look. That's back where it was. We were buying this stock in April. Have you got the share price chart in front of you? I think it's back where it was in June or May or something like that. So it's not.
Yeah, it was about $1 then. It's about $1 now.
Yeah, that's right. It's bounced back as he's laid this strategy out. And look, one thing I really liked, and again, you can overstate the importance of this, but I don't like when a new management team comes in and says, this person was useless and that person was useless and we've got to fix this and we've got to fix that. I went to a big strategy briefing that he did at UBS last week, and he sat there and he said, look, a lot of people have done a lot of really good work to get this business into the shape that it's in. I want to thank them all first. The core business here, there's actually nothing wrong with it. It's going really well. I'm not a savior here. I've laid out a pretty simple plan, and I've got a bunch of good people already around me that are going to help me execute on that. And it's one thing I really like to see in these situations. I don't like I'm going to blame everyone else for all of the problems here. In most businesses, there are a lot of, good people that have worked very, very hard, and I don't think any new management team should be walking in there and criticizing all those people, because you'll get them offside immediately.
Okay. I'm going to ask for, so this is obviously early in the thesis. You've laid out, everyone knows you think probabilistically. You've said that even on this network before. As we go forward then, what are you and the team watching going forward for the business? Like, what are the kind of the keys? So you mentioned like revenue growth, it doesn't have to be that much. Is that an example of some of the metrics that you look at for studying a business like this?
Yeah. So number one for me, and this is a bit different to Catapult, because I think Catapult, it was already just happening. There's a core business here that I really think is fine, and it probably grows at 5 to 6%, and it's already nicely profitable. And we had bought the business on the valuation of that part of it. It's really important to me that they don't erode the value of that. So he wants to grow it faster than that. Great. Interesting. He's got some high hopes for the business. But for me, the downside protection is there's actually something pretty good here already that's nicely profitable and generating lots of cash. Let's not blow it up. So I don't want to see profit margin deterioration here in the near term. So that's the next few results. They reiterated their guidance for this coming year at the AGM last week. I think we talked about that dollar down to 70 cents share price movement. When he got appointed with a growth mandate, I think people were worried that it was going to come with we're going to spend all of our profits here trying to grow it. And that would have been a worry for me as well. So maintaining the margins here, and then we're looking for evidence that the money that they are spending into the growth channels translates to higher than that 5 to 6% revenue growth. And that one's a bit further out. I don't think we're going to see that for the next couple of years. He talked quite openly about this company has been dealing with regulatory issues and restructuring for the past 18 months. Our pipeline is pretty light on. We're not expecting this to grow like crazy in the near term, but we need to rebuild all of that stuff. So for me, it's probably the end of the 2027 financial year. This is a 31 March year end. So the 2027 financial year, we'll start seeing evidence that this business can grow faster than people think it can at the moment. So one really important thing here as well is it has a lot of capital on the balance sheet and it's generating a lot of cash flow. So where that capital goes is going to be important for the future valuation of the business as well.
This business also benefits from the free float of interest rates, right? As interest rates are now significant, they can benefit from that. It's like free carry, right?
Yeah, I would say in the current price, there's an expectation that income goes down quite substantially. I think it's one of the reasons why it's trading where it is people are worried. And I think that is fair. It's not as good a quality revenue stream as I'm just getting fees and the transaction numbers are growing and I generate more and more revenue. So they actually put a slide in using the current interest rate curve and saying by that 2028 year that we're giving you some targets for that interest income will be down to 25% or less of our overall revenue. But it is an important variable over which we have no control.
Yeah. Well, it's something to watch anyway. So this is an emerging kind of story. People can actually, speaking of, people can get the Forager quarterly write-ups and these types of things to play along and to hear straight from you and the team regularly. I cannot recommend them highly enough for people that are interested in learning about investing and learning about the Forager kind of process and the effort that the team under Steve goes to put all this together. One of the things that you and I wanted to do when we caught up in Sydney a couple months ago now, we wanted to make sure that if people listen to the show when we do podcasts together, they have a chance to get in contact. And if they're interested in investing with Forager, that they can do that. There's a link in the podcast player. We were keen to see how many people were interested in running something like into speaking with you and doing something, because I know you're a very busy man, but for anyone that's watching or listening, we've made available effectively five spots in Steve's diary. If you want to talk about the way Forager goes about things, if you're interested in investing but you haven't pulled the trigger yet, get in contact via the link in your show notes or in the podcast player, because you'll be put through to a member of Steve's team and then they'll make the connection with Steve. It's a great opportunity to learn about these companies or just to chat to Steve about maybe you have a position in EML or Catapult or something like this, or just generally looking to allocate to an active manager who genuinely is long-term and genuinely is doing something very different from basically everyone. So that link... Sorry, mate.
I was just going to say quickly as well, and I'm really happy just to talk about the industry in general. I see people make a lot of mistakes when picking fund managers and active funds management, and the active investor community hates me for it, but I'm a big fan of index funds, and I'm really happy to talk about how active fund manager selections can work in well with some more passive stuff on the side. So it doesn't have to be invest in a funds management company where the name starts with F. The conversation I can have with people can be a bit more broad than that.
Yeah. I think that's one of the things that we've found in our community, for what it's worth, Steve, is a community at Rask is very much in tune with this idea that it's not just index, it's not just active. It's like, how do you blend those together? How do you select active managers to build that expression that you want in your portfolio? Like, oh, okay, I want this type of exposure in the Australian market because I'm worried about it just being BHP and CBA at the moment. Maybe I want something else in my portfolio. How do I blend active with, that other strategy, be it passive, be it pure large cap? I don't know, whatever they're doing. But the same for global too, right? And these are the same things, because these are the same things that I think about. It's like, how do I put all that together? Who can I use? How can I get the expression that I want for the amount of risk budget or fee budget or whatever I've got going on? And I think that that would be a really constructive chat. So Steve's time is very valuable coming to Christmas, everyone. So if you are interested, use the link, get in contact, and obviously do it soon. And if you like the show, please leave us a comment on YouTube or just get in contact with us any old way. Steve's also available on Twitter. I'm sparingly on Twitter, but I'll be there if you need me. So get in contact and we can do more of these. I certainly hope we can. Mate, there was one final thing that I wanted to talk to you about, which is like if people, this is not about stock tips, it's not about like buy, hold, sell or anything like that. But if there's like one thing that you would just say, just to recap on these two companies, we've got Catapult, we've got EML. What is the one thing that someone should go away thinking about for each company just to put a kind of like bow on today's discussion?
Well, look, I think for Catapult, whether you own the stock or not, I think it's a great Aussie success story. So follow the story there and just get involved in this company's global expansion plans, because I think they've just signed a league-wide deal with the College Football Association, the SEC, in college football in the US, and they're doing some amazing stuff with them, where the whole ground is kitted out with their stuff. So, but it's probably one of the most interesting businesses just to follow. So I think it's a great example of that. And look, I think with EML, for me anyway, if the listener can understand how we invest in something where there is a huge amount of uncertainty and still think it can be a good investment, even where we might lose our money, that's I think a lesson in and of itself, and that we can manage that risk through portfolio weightings rather than we just buy the stock or we don't buy the stock.
Yeah, love that. Because like you said, it's a range, right? It's a spectrum in financial markets. It's not just some false choice, or you're either in or you're out. You're either all growth and no value, or all value and no growth. It's a spectrum. So that's where you become discerning as an investor. Well, Steve, the link is in the show notes for everyone to get in contact with you. So go ahead and click on that. But Steve, hopefully it's not so long between our next drinks. There was an episode between 2017 and now, and there was a couple in there, but hopefully we get to do this again. So I really appreciate you taking some time to join me.
I've just raced all of the kids signing up for the Melbourne Marathon and got in. So become very popular, this marathon running, Owen. I don't know if you've noticed this, but it sold out in about 15 minutes the other day. So it just proves that if you just keep doing something for long enough, no matter how uncool it was once, it one day becomes cool.
Well, when you run as quick as you can, mate, it's pretty cool. But when you run like me, you don't want to be ended up in the MCG looking like I do. But maybe hopefully when you come down, we can do this in person again. So, mate, once again, thanks a lot.
Thanks for having me on.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.